What's going on, traders? Before we dive into today's lesson, I want to quickly talk about the difference between a congestion and a consolidation structure, because in trading world, these two patterns are very similar and we can basically treat them almost the exact same way, but there's a slight little difference when it comes to the same things. That how do we treat them? The best thing to do is skip trading while the market is in this phase, because it indicates indecision, and the best thing to do is sit on your hands until market gives you a clear direction. But there is a slight difference between a congestion and consolidation. So what is a congestion? I have a picture of a congestion right here, and congestion is typically a bunch of bars stacked next to each other, overlapping without any clear direction. You can clearly draw support and resistance, and you see that there is no room to either one of those extremes, and it is both tempting to buy and sell at the same time. This is a congestion. EMA is also a lot of times in the middle of these bars. The best way to trade this congestion is to not trade it and wait for price to break out in either direction and fade the breakout, trade a breakout in the opposite direction. So when there is no room between the bars and they're stacked next to each other, this is a strong congestion. Here's another example of a congestion. Bunch of bars overlapping, lot of stems going sideways. There is no room between the bars, no clear direction. If you go on a higher time frame, you would see a big doji bar without any direction. This is what you would see on a higher time frame, indecision. EMA is in the middle of bars, and it's tempting to both buy and sell at the same time. And the way you trade it, you wait for the breakout and you trade it into opposite direction. So this is a congestion and this is a no trade zone. But what is a consolidation? Consolidation looks very similar to congestion, and we have an example of a consolidation structure right here. There are a lot of bars going sideways, but they are not stacked next to each other. They are not overlapping, and you guys can see that there's room between the bars. So you guys can see there's a room right here, there's a room right here, there's a room right here, and there's a room right here. This is not a tight little congestion. Price is not stacked next to each other, and the difference is we can actually treat a consolidation structure as a little trading range. We can sell highs and buy lows. Now preferably you still want to sit on your hands while the market is in this phase, because it represents indecision and you don't want to be gambling and taking a chance. But there's a slight difference between a congestion and consolidation. So when you see a little gap between the bars, it doesn't look that too stacked, it is just a sideways movement, you can still take a decent entry, okay? But we will get to this setup. Today started with quite a lackluster price action. We had a downtrend working lower and we have an uptrend working higher, and you want to draw these short-term trend lines so you know which side of the market is in full control. And while this trend line remains unbroken, the sellers are in control. After a break, traders will attempt to create a new extreme, and then we can expect correction or straight up reversal. Now this structure overall was very similar to a previous structure I'm going to show you guys. This is what I'm looking at. We have a downtrend working lower with the break and a new low, and we have this uptrend working higher. So today started very similarly as a week ago, and there was a move below EMA, and we had something very similar. We had a big move below EMA, and here we have a little bit of a dilemma. We either wait for price to create a new extreme of this previous uptrend, or we wait for price to push in the bearish direction. So what do we do in this instance? We wait how the price will react at the EMA. If price pushes above the EMA, there's a clear indication that buyers are in control and we should be looking for a new extreme. If price remains below EMA, then we should be looking to sell. And there was actually a new extreme right here, and there was a first entry short, little pullback higher, second entry short. But you can see there is a shortened trend line in play. There's a high likelihood that we're going to wait for a new extreme of this trend, and also there's a lot of stems, a lot of bars are starting to overlap, and by the time, if you enter right here, you get stuck in this trade, you have a chance to exit the break even. But at this point on, you have to exit because the shortened trend line is preventing you from the second entry short to work. All right, so this would be a little bit tricky trade right after the open, but by the time the market is really overlapping, there is no clear direction, short-term trend line is in play, and there is really no setup yet. Price breaks higher and turns down. However, there is no clear entry yet either, so you just have to watch this go without you. And with the price pushing lower, it's confirming the bearish momentum. So this is why I drew the short-term trend line, kind of get the feel what the pattern may be, because we basically started trading to the downside for the majority of the session right now. And a strong push below EMA indicating a bearish structure, and there's a new high, first entry long, little pullback, second entry long, failure. Second entry long in an uptrend is a high probability setup of the key entry points, but second entry long in a downtrend is a trap. So this right here is a trap because people are buying against the trend. We're below EMA. I had a little bit better signal bar. I had a much bearish bar. If I had a bar like this before I reloaded my historical data, I would not have entered this doji looking bar. I had a nice bearish bar. It was two failed attempts up, EMA held price, so it was a high probability setup and it was a scalp. This signal bar, however, is very doji-like, very neutral, and there is no entry right here. But I want to show you guys what I was looking at the time. Price confirming the bearish momentum and a trap. Two failed attempts in the previous trends. Direction market pushed lower and market pushed strongly higher. But remember, this downtrend just had a break, so we're most likely going to create a new extreme according to trendline rules. But you have to draw the short-term trend lines as well for the corrections, so they keep you on the right side of the market. Same thing they did right here. You have to respect the short-term trend line up here. So do you have an uptrend working higher? You have a break, move to a new extreme to the very tick and instant reversal. At this point on, you may be wondering, is it safe to sell? It's not safe to sell yet because price remains above the EMA, indicating bullish momentum. You need to wait for price to push back below EMA so that you know that the downtrend is in full effect, is resuming, and you can wait for a new extreme. Okay, so while you're looking at this, all you have in mind is the new extreme short according to price action rules. All right, there's a new high and there's only a first entry long failure. This is a lower high setup of this breakout. We came to the EMA, which is a key entry point with trend line, support, resistance lines. We move quite a bit, and generally when you're trading a lower high setups, you want them to happen right after the breakout area or the second entry. We moved quite a bit, so me personally, I didn't take this entry because I didn't really trust it. Looking back, this is a nice bearish signal bar confirming the EMA. You're still looking for a new extreme and you're confirming the key entry point, so this is a decent entry. And then you have a second entry long failure, but you're going short at the directly the low of the move, so you don't want to take that chance. A market, it either worked, but that's not the point here. And take a look what happened. This candle right here formed a new extreme. We have a new downtrend because this low is lower than the previous low. So after you have a break and a new extreme, according to trendline rules, you expect for price to go into consolidation or straight up reverse. So take a look what you have here. You have a new extreme, you have a first entry short, second entry short, and you will be tempted to take the second entry short because two-legged pullback at the key entry point with the direction of a trend is a high probability setup. But remember, you don't know that you're going to continue working lower. You have a new extreme and you're expecting possibly a new trend in the opposite direction to begin. So there is no entry yet. Plus you have the short-term trend line in play. There is a little break and there is a new extreme. Just like we talked about, price is working sideways. There is no denying, but there is a room right here. There is a room right here. So there is a little bit of room to breathe, and it's not such a horrible overlap. Okay, this is just a sideways movement that we can treat it as a trading range and sell highs and buy lows. And by the time you have an uptrend, break, attempt to create new extreme, triple top right here, big bearish bar, pushed back below EMA. And once the price is trying to push higher and we're trying to get a reversal pattern, we're trying to, after new low, trying to get the correction or either straight up reversal, it keeps failing every single time. Failed here, and now the price failed a third time to close above the EMA. In this instance, you get enough information that the EMA is holding prices and the downtrend may resume. Okay, that can happen. Just because trendline rules will say that after a break you can expect correction or straight up reversal, that doesn't mean that you will close your eyes and start buying. There's a first entry short, second entry short, failure, reversal pattern. Very tempting. I was looking for longs, but you close below EMA, and this is really important. Had you closed above the EMA, this is a great long, but you close below EMA, and that is telling you something. Once again, bullish bar, you close below EMA. You cannot keep closing below EMA. This is showing you a lot of sellers at the EMA are still participating. All right. So just because you have a break in your extreme, that don't mean that the current trend will not resume, but you always want to err on the side of the opposite trend. Most often than not, you will reverse in the opposite direction. Quick, easy scalp, and market consolidated. It broke higher. You can treat it as a failed breakout, but at the time, you don't have this trend line yet at the time. So you're really just going sideways for the most part. And yeah, I didn't really like going short here. There's really by the time you get here, you're really going sideways for a long period of time. There's a new high, first entry long, second entry long, but EMA is in the middle of those bars, sideways movement. We've been going sideways for 16 for hour. From this point to this point, this is 1 hour worth of price action. So that tells you that it is better to not take any entry because you can get chopped into pieces in this. So what you have a short-term trend line, you have a break, new extreme, and a straight up big reversal, confirming the bearish pressure. You pulled back into trading range, you pushed lower, and it gave you a lower high setup, retesting the resistance, nice bearish bar. And by this time you can see, because you can see a bearish imbalance working right now, you can see that every single push above the EMA basically get instantly sold, and you keep pushing back below EMA. Each new low is lower than the previous low. This is what it's called a bearish imbalance. So you're expecting for breakout to work. Once you see a bearish imbalance, you don't want to be buying the breakouts. You want to be betting. You don't want to trade the breakout in its breakout phase because that's always dangerous. You can always get the breakout pullback, and also your stop loss is on the wrong bar. Let's say you want to sell this area right here. Where do you put your stop loss? You have to put it somewhere randomly and you can get stopped out on the noise. So never sell the breakout in its breakout phase. Always wait for breakout pullback. But this is the bearish imbalance. Each new low is lower than the previous one, and you keep closing below EMA, so you have to respect the downtrend. And once you have this breakout below this important key level, this is how can you tell that the breakout will succeed. It created a pullback, as a lot of times the breakout will, but it is really truly better not to take a chance here. And take a look what you have. Price strongly sold off. And what does this look like? This is one of those almost 90-degree angle moves. 90-degree angle moves, they are not long-term sustainable. They will get reversed, and they're very quickly, or they're also going to be a pullback very quickly. So it is not safe to be selling right after the 90-degree angle move. There's a new extreme, and there's a first entry short, pullback, second entry short. But you're coming from the lower trend line after 90-degree move, so you're most likely heading to where? To the other trend line. Remember, this is like a trading range, just slightly slanted. Okay, if you took this bar and you took a chance here, I wouldn't really blame you, honestly. This is a nice bearish bar off the EMA, and it takes a little bit of experience to recognize that once you came after a 90-degree move so far down. Also, this is a breakout area, so you know what's going to happen. Once price breaks below this breakout area, you're most likely going to retest it and come back to the breakout area. And it did to the very tick. And take a look what happened. It retested the breakout area and then sold off. So once you see this strong bearish move below the breakout area, you can expect a little bit of a more significant bullish correction to test back the breakout area. But if you went short right here, you took a chance on a second entry short off the EMA, which I cannot blame you. And this was a decent entry to take a chance on, calculated, and there was just little nuances that like could have kept you out of this trade. The market push higher, pull back, and there's really no clear direction, no clear setup, because you keep forming support. So you don't want to sell into the support, but at the same time you don't want to buy either. There's the new low, there's a first entry short, pullback, 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 a second entry short, failure. You close above the EMA, you're in this trend line. I'm going to mark this setup. This is a nice trap felt second entry short, because people want to go short on a second entry short. They've watched all this move go down, and now once you're bottoming here and you're pushing strongly above the EMA, they want to go short, which is now too late. Market is reversing, but always remember to draw the short-term trend lines. They will keep you on the right side of the market. As you guys can see, the bulls are in control until there is a break and a new extreme, and a lot of times there is a more than one leg pullback, second leg, two legs to a new extreme. So now you know that the bulls are no longer in control, and price bounces where? At the important key level. This is where all the magic happens. And once you see price confirming your key level, key entry point, the more touches you have, the better. You cannot argue with this. Look at this. First two touches right here, 4, 5th touch right here. So this is a clearly a proven trend line, and this place right here will put odds on your favor. The likelihood that the trend trades will work in your direction, which is short, is increasing tremendously. So every time you see a price coming off your key entry point, and this is clearly not subjective because you get multiple confirmation. you get 5 confirmations. So this is a clearly objective trend line. 2 legs to new extreme, uptrend played out, nice reversal bar. Everybody started buying at the very end of the bar. Everybody started selling. You want to go short here. This is the new extreme. And remember, price broke the breakout area and came back, retested it. They took off all the break-even stops. They like to, they like to take out these runners, and then it turned lower. And you have first entry long, pull back, second entry long. But remember, overall pattern takes precedence, and overall trend is down. Even though it looked a little bit range-like, we never created a high that was higher than the previous one. We kept making lower highs and lower lows. So this was from the very open downtrend structure. So there's a first entry long, second entry long against the trend, confirming the key entry point and turn down lower, bearish bar. This is a high probability setup. Market push lower. I gave you a little bit of kind of like a breakout pullback, confirming the trend line. Once again, if this closed below EMA, this would have been an easy no-brainer trade. But since it closed above the EMA, you want to be a little bit careful, but still, your odds are on your side that the trade is going to work. And trading is about probability. It's just like playing the casino. And in this instance, you own the slot machine. You are the casino. You have odds on your side, and you have to take the entry. And there is new low, first entry short, pullback, second entry short, close below EMA, trend line. So you have 2 key entry points, which creates a strong confluence. And this is also a momentum trap bar. You triggered higher and instant reverse on a one single bar. This is a good momentum and market push lower. And now it's reversing, and we are finally working higher into the later hours of the day. So this was the structure for the day. Remember, congestion, consolidation, slightly different. Quite easy day. I took 2 trades. I took this trade right here, and I took this trade right here. And overall, fairly decent day, but you have to remain patient during the consolidations and congestions when you're unsure what to do. Every single time you're unsure what to do, just be patient. Not trading is like money, is like putting money in the bank, and you can never go wrong not taking a trades here and there. Of course, if you keep being scared pulling a trigger, that's a mental error. But if you're trading normally and you want to be a little bit more patient, that's always the right idea. It's better to be safe than sorry. So I'm going to see you guys in the next one. Take care, everybody.